Adjunct Professor Moran, Macroeconomics 111, Open Market Operations. Monetary Policy. We're going to do an example of open market operations. We're going to take an example of the reserve ratio and the discount rate. We're going to assume the reserve ratio is 20%. As a result, we're going to calculate the money multiplier, 1 over 0.2, which is 20%, gives us a money multiplier of 5. Okay? The change in the money supply equals the change in excess reserves times the money multiplier. So we're going to have to calculate excess reserves. The formula we're going to need to use is checkable deposits times subtract. Okay. First thing we have to do is calculate required reserves. So we're going to take checkable deposits times the reserve ratio as a percentage equals required reserves in dollars. Then we're going to take total reserves minus required reserves in dollars, the number we just calculated, and that gives us excess reserves. Then we're going to take excess reserves and multiply it by the money multiplier. And this will be the change in the money supply resulting from an initial change in checkable deposits. Okay. The money multiplier results because loans by one bank are deposited as checkable deposits in another bank. As a result of this increase in checkable deposits in the second bank, they now have additional excess reserves, a portion of the new deposit not required to be held as reserves. That bank can loan out those excess reserves, which will then be deposited in another bank, and this continues until you get, and that reflects the money multiplier. Now, there are two ways of doing this. There are two ways of accomplishing the same goal. All right, this is going to be expansionary. This will be contractionary. When the Federal Reserve undertakes open market operations, buying or selling bonds from the public or financial institutions, they'll achieve the same change in the money supply, but it will happen two different ways. Because if the Federal Reserve buys the bonds from financial institutions, checkable deposits aren't affected at all, and all the money can be loaned out. But if the Federal Reserve buys the bonds from the public, part of that check sent to the public will have to be kept in the bank as required reserves. So in the end, they'll both achieve the same result, but it'll happen two different ways, and that's what we're going to explore here. So let's say the Fed buys a bond from the bank. The Federal Reserve sends the bank money in exchange for the bond. So the Fed receives the bond, and the bank receives $1,000. That goes into owner's equity, not checkable deposits. So we do not apply the reserve ratio to owner's equity. Does money held by the bank count as M1? No. How much did checkable deposits change? Didn't. Owner's equity change. How much did the reserve requirement change? Didn't. How much did this check excess reserves? 1,000. The entire amount goes from total reserves. Nothing stops at required reserves, and so $1,000 falls into excess reserves. Using the money multiplier, what's the change in the money supply? Money multiplier, 1 divided by the reserve ratio, is 5. That would cause a change in the money supply of 5,000. Now, let's say the Federal Reserve instead buys bonds from the investing public. The Fed receives the bond, the public receives a check for $1,000, and the public deposits it in the bank. How much did checkable deposits change by? 1,000. How much does this deposit count as M1? Yes, it does. In fact, checkable deposits are the largest component of M1. How much did required reserves change? Well, $1,000, 20% of that is $200. Required reserves go up $200. How much can excess reserves change by? 1,000 minus required reserves is $800. Using the money multiplier, how much will N1 change if excess reserves are fully loaned out? The money multiplier is 5. That would cause a change as a result of loans of $4,000. This also has to be counted as a change in the money supply because it was held by the federal government and now it's held by the public where it counts. And that would cause a $5,000 change in the money supply. they're equal but happen two different ways. When the Federal Reserve buys the bonds from the bank, it doesn't affect checkable deposits, and all of it can be loaned out. So you get $5,000 worth of loans, but no initial change in the money supply. But when the Federal Reserve buys the bonds from the investing public, that counts as checkable deposits, which then you have to apply checkable deposits the reserve ratio to. Only part of it can be loaned out, which results in a smaller change in loans, but the initial deposit counts. And so there's an equivalent $5,000 change. This is kind of an important formula for these problems, because the mistake you make is you may, instead of applying the reserve ratio to checkable deposits, you may apply the reserve ratio to total reserves, and that's not correct, because total reserves combines both checkable deposits to customers' money, which the government wants to protect by ensuring some of it is on deposit in the bank, and total reserves commingles those checkable deposits with owners' equity, and the owners are allowed to add as much as they want to total reserves and loan out all of their own money. So only the portion of total reserves that represents checkable deposits is the reserve ratio applied to. You can practice with the same problem in contractionary monetary policy here. The second tool of monetary policy is the reserve ratio. If the reserve ratio changed to 30%, recalculate what happens when the Federal Reserve buys a $1,000 bond from the public. Okay, there's an initial change of checkable deposits of $1,000. A 30% reserve ratio means $300 has to be kept on deposit and $700 is excess reserves. $300 is required reserves and $700 is excess reserves. The money multiplier is now over 1.3, which okay, 1 divided by 0.3 equals 3.3. 3.3 times 700 we'll say is 2310 is the change that results from loans. Add that to the original 1,000 and we have increase in the money supply of 3,310. Notice that increase in the reserve ratio has resulted in a smaller change for the money supply. So raising the reserve ratio is contractionary. The last tool of monetary policy is the discount rate. If the bank, instead of loaning out $700, loans out $800 and only has $200 in required reserves, the bank will be charged a penalty to make up that. And if they borrow the money from the Federal Reserve, they'll pay something called a discount rate. If the penalty goes up, the banks are much less likely to loan out excessively. So if the penalty goes up, the penalty for loaning too much money increases, so banks will loan out less. But if the penalty goes down, banks are much more likely to be aggressive and possibly loan out more than they should, and that's expansionary. We'll sketch what happened here in the expansionary scenarios is there was S1, S2. The Federal Reserve increased the supply of money by buying bonds from the public and increased the supply of money. Increasing the supply of money causes interest rates to fall, which durable good orders will go up for consumers and business orders for capital equipment will go up also. Alright. They could lower the reserve ratio. They could lower the discount rate, and that would have the same impact of increasing the supply of money. Now, what impact does that have on our aggregate demand aggregate supply model? So we'll sketch that. We're in a recessionary scenario. Don't forget to write that this is GDP sub R for real. This is the price level. Here's our resulting rate of inflation. And here's our resulting GDP. By increasing the supply of money, causing interest rates to fall, consumer spending increases on durable goods, there's a good connection to make, and business spending, gross private domestic investment, would increase on capital goods. They would hold more. They might hold more inventory as it is less expensive to hold, and construction might increase. Remember that IG was explained as a negative relationship between interest rates and the amount of business spending that would be undertaken. That would cause aggregate demand to shift this way, hopefully achieving GDP full employment. And you can practice with the recessionary one yourself. Using the three tools of monetary policy, either expansionary or contractionary, the money market graph, and then a consolidated aggregate demand, aggregate supply graph.